$500 million. In today's financial world, that doesn't sound like much. Governments burn through that amount before lunch. Tech companies lose it in a bad earnings call. Central banks create it with a few keystrokes. And yet, when BlackRock quietly moved over $500 million into crypto-related positions, something strange happened. Nothing. No fireworks. No explosive rally. No urgent breaking news banners flashing across financial television. In fact, most people didn't even notice. And that's exactly why this matters. Because the most important financial shifts rarely announce themselves. They don't arrive with headlines or excitement. They arrive quietly, almost invisibly, while attention is focused somewhere else. So here's the question we need to ask. If this move really signals the end of the crypto bear market, why didn't it feel like the beginning of anything? To understand that, we need to rethink what bear markets actually are and how they really end. Most people believe bear markets end when optimism returns, when confidence comes back, when prices finally start going up again. But history tells a very different story. Bear markets don't end with hope. They end with exhaustion. They end when sellers are gone. When panic runs out of energy, when bad news stops pushing prices lower. And that's the environment institutions like BlackRock wait for. Not excitement, not hype, but silence. This video isn't about predicting prices. It's not about calling tops or bottoms. And it's definitely not about crypto hype. It's about understanding signals, the kind that only show up when you stop looking at charts and start watching behavior. Because when the world's largest asset manager moves quietly, the most important question isn't what they bought. It's why they waited until now. Most people imagine bear markets ending with a clear turning point. A positive headline, a policy announcement, a sudden wave of optimism, something that makes everyone collectively say, okay, the worst is over. But that's almost never how it happens. In reality, bear markets end in a far quieter, more uncomfortable way. To understand this, imagine a crowded movie theater where someone suddenly shouts that there's a fire. At first, everyone rushes for the exits. People panic. They push. They don't want to be last. That first rush is violent, just like the early phase of a bear market. Prices collapse quickly as everyone tries to get out at the same time. But then something changes. After a while, the exit's clear. Most of the people who were scared enough to leave have already left. The fire alarm may still be ringing, but the stampede is over. That's when the room goes quiet. This is what happens near the end of a bear market. The news is still bad. The outlook is still uncertain. But prices stop reacting the way they used to. A negative headline hits, and instead of another sharp drop, the market barely moves. Sometimes it even drifts upward. Not because people feel optimistic, but because there's simply no one left to sell. This phase is uncomfortable because it doesn't feel like a bottom. There's no celebration, no relief, just fatigue. Retail investors are usually gone by this point. Many have sold at a loss, sworn off the market, or stopped paying attention altogether. But institutions are different. They don't need optimism to buy. They need asymmetry. They look for moments when the downside is limited, but the upside over years, not weeks, remains open. That's why institutional money often enters when markets feel dull, boring, and unresolved. And that's why the timing of BlackRock's move matters far more than the size of it. Because by the time the headlines turn positive, institutions are usually already positioned. When you're ready, say, next chapter, and we'll move on to understand why BlackRock's $500 million move matters, we first need to clear up a common misunderstanding. BlackRock is not a trader. It's not a hedge fund trying to time the market. It's not a venture capital firm chasing the next big thing. And it's definitely not a speculative crypto whale. BlackRock is an asset manager, the largest in the world. It oversees more than $9 trillion on behalf of pension funds, governments, insurance companies, sovereign wealth funds, and long-term institutional investors. That money isn't looking for quick wins. It's looking for stability, durability, and long-term returns. When BlackRock allocates capital, it's not asking, will this go up next month? It's asking something very different. Will this still exist and matter 10 years from now? That difference is critical. Because when you manage money for teachers' pensions, retirement systems, and national institutions, your risk tolerance works in reverse. You can't afford to chase hype, but you also can't afford to ignore structural change. That's why BlackRock didn't rush into crypto in the early years. The volatility was extreme, the infrastructure was immature, the regulatory risk was too high. From BlackRock's perspective, crypto back then wasn't an asset class. It was an experiment, but experiments either fail or they stabilize. And over the past few years, especially through the bear market, crypto went through something institutions care deeply about. Stress testing. Exchanges failed. Leverage collapsed. Fraud was exposed. Weak projects disappeared. Painful as it was, this process did something important. It reduced uncertainty. By surviving its worst period, crypto began to look less like a speculative bubble and more like an emerging financial system that had been forced to grow up. So when BlackRock finally moves, it's not because they suddenly believe in crypto. It's because, in their assessment, crypto crossed a threshold from fragile to resilient. And that shift only becomes visible after a bear market has done its damage. When you're ready, say next chapter, and we'll continue with... To most people, $500 million sounds enormous. It's life-changing money. It's city-building money. It's the kind of number that feels decisive. But inside BlackRock, context matters. When you manage trillions, a $500 million allocation is not a full commitment. It's a signal allocation. Think of it like a chess opening, not a checkmate. Institutions rarely move in all at once. They scale in deliberately, in phases, because their goal isn't to win quickly, it's to avoid catastrophic mistakes. A signal allocation serves several purposes at the same time. First, it tests liquidity. BlackRock needs to know how easily large positions can be entered and exited without moving the market too much. Crypto markets, especially after a bear cycle, can behave very differently under institutional-sized orders. Second, it tests infrastructure, custody, settlement, compliance, counterparty risk. These things don't show up on price charts, but they matter more than price to institutions. Real capital has to move through real systems without breaking them. Third, it tests regulatory comfort. BlackRock doesn't just answer to markets. It answers to regulators, clients, and governments. A smaller allocation allows them to prove that the process works under real-world scrutiny. In other words, this move wasn't about returns. It was about readiness. BlackRock wasn't asking, how much can we make? It was asking, can this asset be safely integrated into institutional portfolios? And that's a very different question. If the answer were no, the allocation would quietly stop there. But if the answer is yes, this kind of move becomes the foundation for much larger flows, later flows, that arrive slowly, methodically, and without fanfare. That's why the number matters less than the timing. Because institutions don't test systems when they're unstable. They test them when the chaos has already passed. When you're ready, say next chapter, and we'll move on to someone watching prices, BlackRock's timing might seem late. Crypto had already fallen. Speculative excess had already been wiped out. The headlines were still cautious, even pessimistic. So why move after all that damage? Because institutions don't see pain the way retail investors do. Retail experiences pain as loss. Institutions experience pain as information. Bear markets expose everything that doesn't work. They reveal which business models are fragile, which systems fail under stress, which assumptions were wrong. During crypto's bear market, a lot broke. Over-leveraged funds collapsed. Weak exchanges disappeared. Projects with no real utility faded away. From the outside, it looked like the ecosystem was falling apart. From the inside, from an institutional perspective, it looked like a cleansing. Think of it like a storm passing through a forest. The weakest trees fall first. Diseased branches snap. Unstable structures collapse. What remains afterward isn't weaker, it's stronger. By waiting until after the worst of the pain, BlackRock allowed the market to do something crucial on its own. Self-correct. They didn't need to guess which players were resilient. The bear market already answered that question. What was left standing had proven it could survive stress, scrutiny, and prolonged uncertainty. And survival is the first requirement for institutional capital. This is why BlackRock didn't buy at the peak, when everything looked perfect. They waited until things looked broken, but functional, because that's when systems reveal their true strength. One of the most counterintuitive things about financial markets is this. The moments that feel safest to buy are usually the most dangerous, and the moments that feel uncomfortable are often the most important. This comes down to a fundamental difference between retail psychology and institutional psychology. Retail investors tend to buy narratives. Institutions buy conditions. Retail asks questions like, is everyone bullish? Is this going up? What are people saying on social media? Institutions ask very different questions. Who is still forced to sell? Where is leverage sitting? What happens if this goes down another 20%? Confidence is not a signal institutions trust. In fact, high confidence usually means risk has already been priced in. Low confidence, on the other hand, creates something institutions care deeply about: asymmetry. Asymmetry is when the downside is limited, but the upside over years, not weeks, remains open. After a long bear market, most of the emotional sellers are gone. People who couldn't tolerate losses have already exited. Leverage has already been flushed out. Weak hands are no longer setting the price. At that point, the risk profile changes. Not because the future is suddenly clear, but because the worst-case scenarios have already been partially realized. This is why institutional buying often feels confusing in real time. There's no excitement to point to, no optimism to celebrate. Just a quiet shift in behavior. BlackRock didn't wait for confidence to return. They waited for fear to lose its power. When bad news no longer causes sharp sell-offs, institutions start paying attention. Not because the news is good, but because the market's reaction has changed. And that change in reaction is one of the strongest signals that a bear market is nearing its end. When you're ready, say next chapter, and we'll continue with, most people experience markets through price. Green candles feel good. Red candles feel painful. Everything seems to revolve around what the chart is doing right now. But institutions don't think that way. They follow flow, not price. Price tells you what people are feeling in the moment. Flow tells you what capital is actually doing beneath the surface. Think of price like the surface of the ocean. Flow is the current underneath. You can have calm waves while a powerful current is forming below, or violent waves even as the current weakens. BlackRock's $500 million move wasn't about pushing prices higher. It was about positioning ahead of future demand that doesn't show up all at once. Institutional demand moves slowly, in layers. Pension funds adjusting allocations. Wealth managers adding small percentages. Endowments diversifying exposure. Products being built for long-term clients. None of this creates a sudden spike. Instead, it creates a floor. That's why bear markets don't end with explosive moves. They end with stability. Price may still move sideways. Volatility may remain elevated, but the character of the market changes. Selling pressure fades. Liquidity improves. Large players can operate without disrupting the system. When BlackRock allocates capital, it's not chasing momentum. It's aligning itself with where it believes capital will need to go over the next several years. And that kind of positioning rarely makes noise. It just quietly reshapes the market from the inside. At first glance, this crypto cycle might look like all the others. A surge of excitement. A collapse driven by excess. A long, painful recovery. But underneath the surface, something important has changed. Previous crypto cycles were powered almost entirely by retail behavior. People bought because prices were rising. They sold because prices were falling. Infrastructure was improvised. Risk was poorly understood. This time, the center of gravity has shifted. What's emerging now isn't a retail-driven market. It's an institutionally shaped one. Custody no longer means keeping private keys on a flash drive. It means regulated custodians, insured storage, and audited processes. Access no longer requires navigating unregulated exchanges. It flows through ETFs, trusts, and compliant investment vehicles. Risk isn't ignored, it's measured, modeled, and constrained. This changes how cycles behave. In earlier cycles, when confidence broke, the entire system cracked. Liquidity vanished almost instantly because it was built on fragile assumptions. Now, liquidity doesn't disappear the same way. It redistributes. Institutions don't rush for the exit at the first sign of trouble. They hedge, they rebalance, they adjust exposure gradually. That doesn't eliminate volatility, but it changes its rhythm. This is why BlackRock's move matters. Not because it guarantees a rally, but because it signals that crypto is no longer being treated as an experiment that could vanish overnight. It's being treated as a system that can be incorporated, managed, and absorbed. And once that shift happens, the rules of the game change. When you're ready, say next chapter, and we'll move on to, for years, regulation was seen as crypto's biggest threat. Every headline about government scrutiny felt like an existential risk. Every new rule sounded like an attempt to shut the system down. Retail investors learned to fear regulation. Institutions learned to wait for it. Because from an institutional perspective, no regulation is worse than strict regulation. Unclear rules mean undefined risk. Undefined risk means capital stays on the sidelines. What quietly changed over the last few years wasn't that regulators suddenly embraced crypto. It's that the rules began to solidify. Custody standards became clearer. Disclosure requirements were formalized. Market surveillance improved. Legal definitions started to form. This didn't make crypto exciting. It made crypto investable. BlackRock doesn't need regulation to be friendly. It needs regulation to be predictable. Once firms can answer questions like, who is responsible if something fails? How are assets legally classified? What compliance standards apply? Capital can move. This is why BlackRock didn't rush in earlier, even when prices were soaring. High prices don't reduce legal risk. Clear rules do. And when enough of that uncertainty was removed, crypto crossed another invisible threshold from regulatory gray zone to structured market. That shift didn't happen overnight, and it didn't happen loudly. But once it happened, the biggest barrier to institutional participation quietly disappeared. When you're ready, say next chapter, and we'll move on to, when people hear the end of the bear market, they often imagine a sudden reversal. Prices exploding upward. Social media turning euphoric. A sense that the worst is clearly behind us. But that's not how market cycles actually turn. The end of a bear market isn't a celebration. It's a transition. It's the point where the forces pushing prices down lose their strength long before the forces pushing prices up become obvious. BlackRock's $500 million move doesn't mean crypto is about to skyrocket. It means something far more important. The structural selling phase is likely over. In a true bear market, prices fall because sellers are forced. They sell to meet margin calls. They sell because their businesses fail. They sell because they can't hold on any longer. Once that forced selling is exhausted, markets behave differently. Bad news still exists, uncertainty remains, but prices stop collapsing. This is the phase where capital with patience starts to step in, not to chase returns, but to secure exposure at a time when risk is no longer one-sided. That's what BlackRock's move represents. Not confidence, not optimism, but a recalibration of risk. It's a recognition that the downside has been partially realized, while the long-term upside still exists. And historically, that moment when smart money stops exiting and starts positioning is what marks the end of a bear market. even if it doesn't feel like it yet. When you're ready, say next chapter, and we'll continue with, when markets reach this transition point, expectations often split into two extremes. One group expects an immediate rally. The other expects another collapse. Both are usually wrong. What typically follows the end of a bear market is not excitement, but frustration. Prices move sideways. Volatility spikes and fades. Momentum traders get chopped up. This phase exists for a reason. Markets need time to rebuild trust. After a long period of losses, participants are cautious. They don't rush back in. They test the waters. They wait for confirmation. Institutions behave the same way, but at a different scale. BlackRock's move doesn't mean every institutional investor suddenly piles in. It means the door is open. What comes next is gradual. Small allocation increases. New products being designed. Risk committees updating models. Advisors testing client demand. None of this creates headlines. And that's why this phase feels underwhelming to retail investors. There's no obvious signal to react to. No clear narrative to follow. But under the surface, something important is happening. Markets are being rebuilt around long-term holders, not short-term speculation. That doesn't eliminate risk. It doesn't guarantee returns, but it does change the nature of future cycles. The next bull market, whenever it arrives, will not be fueled by the same fragile dynamics as the last one. And that difference matters more than timing. It's easy to look at BlackRock's crypto move and treat it as an isolated event, a trade, a bet, a headline. But that misses the bigger picture. What's really happening here isn't about crypto alone, it's about how capital adapts to structural change. Every major financial innovation follows a similar path. At first, it's dismissed. Then it grows too fast. Then it collapses under its own excess. And finally, it gets absorbed into the existing system. This happened with railroads, with electricity, with the internet, with derivatives, with ETFs themselves. Crypto is not breaking this pattern. It's following it. The bear market wasn't the end of crypto's story. It was the point where the system was forced to confront its weaknesses. Speculation gave way to infrastructure. Narratives gave way to processes. Hype gave way to governance. BlackRock's involvement isn't about disrupting traditional finance. It's about integrating crypto into it. That's a critical distinction. Institutions don't replace systems that work. They extend them. They look for technologies that can be folded into existing frameworks, risk models, custody structures, compliance systems, and client portfolios. Crypto has now evolved to a point where that integration is possible. And once integration begins, the asset stops behaving like an outsider. It becomes part of the background machinery of finance. That's not exciting, but it's transformative. At this point, it's important to be clear about one thing. Understanding BlackRock's behavior does not mean copying it. You don't have the same time horizon. You don't have the same risk constraints. And you definitely don't have access to the same tools. But what you can learn from BlackRock is how signals work in financial markets. Retail investors are taught to look for confirmation in price. Institutions look for confirmation in behavior. When a firm like BlackRock allocates capital, it's revealing how it sees the balance of risk, not just today, but years into the future. This matters because most major losses happen when people misunderstand where they are in the cycle. They buy aggressively when risk is highest. They sell in frustration when risk is already reduced. BlackRock's move doesn't mean crypto is safe. It means crypto is less fragile than it was before. That distinction matters. Lower fragility changes how markets respond to shocks. It changes who holds assets during downturns. It changes how quickly panic spreads, or doesn't. For individual investors, this isn't a call to action. It's a call to awareness. When the largest asset manager in the world stops treating an asset as radioactive and starts treating it as manageable, something fundamental has shifted, not in price, in perception. And perception is what shapes capital flows over the long term. When you're ready, say next chapter, and we'll move to the final section. Let's return to where we started. $500 million? Not shouted, not celebrated, not even widely discussed, just quietly deployed. If you were waiting for a clear announcement that the bear market is over, you probably missed it, because markets don't ring bells at turning points. They whisper. The end of a bear market rarely feels like relief. It feels like confusion. Bad news is still everywhere. Skepticism still dominates conversations. Optimism feels premature, even foolish. And yet, prices stop collapsing. That's when smart money changes behavior. Not dramatically, not emotionally, but deliberately. BlackRock didn't announce a new era for crypto. It didn't promise returns. It didn't try to convince anyone. It simply acted. And in finance, action matters more than narrative. Silence from smart money doesn't mean nothing is happening. It usually means positioning is already underway. By the time confidence returns, by the time the story feels obvious, the most important decisions have already been made. This doesn't mean the road ahead is easy. It doesn't mean volatility disappears. And it doesn't mean every risk is gone. It means something more subtle and more important. The market has shifted from survival to adaptation, from panic to process, from speculation to structure. And once that shift happens, the character of the market is never quite the same again. The bear market doesn't end with applause. It ends when no one is paying attention. And this time, the silence spoke volumes.